Well, welcome everyone. Welcome to Office Hours with Michael Kitces. So for today, I want to talk about the big news that hit the wires this morning, that Betterment, the original robo-advisor, has declared that it's no longer just in the robo business, it's becoming a human advisor platform. So for some context here, since 2012, Betterment has operated a three-tier price structure. There was kind of a core advisory service for 0.25% with at least $10,000 that gave you that robo-advisory services. And if you were over $100,000, the 25 bip fee dropped down to 15 basis points. And then if you were under $10,000, there was a 35 basis point price tier as long as you were contributing at least $100 a month. If you weren't, you had to pay a $3 a month flat fee, which could actually be a bit higher as a price. So given that Betterment had an average account size of a little over $20,000 for most of this time, basically it was squarely in the 25 basis point advisory fee range with some larger accounts that were cheaper once you got over $100,000. So given that is history, I think it's really big news this week that Betterment announced it's switching to a uniform flat 25 basis point fee across the board, no minimum balance or fees, but no more upper tier. So for smaller accounts, that's actually a 10 basis point cut. You go from 35 basis points down to 25. But for the larger accounts, that's actually a 10 basis point increase. And that's not trivial. Like in relative terms, clients over $100,000 with Betterment that were paying in the past just got a 40% fee increase from 15 basis points up to 25 basis points. When they see that next billing statement come through, that fee line is going to be 40% higher than it used to be. Now, perhaps even more notable than that fee change, Betterment also announced a couple of new pricing tiers as well. So in addition to this core Betterment digital solution that's now going to be a uniform 25 basis points across the line, there's now Betterment Plus, where if you have a $100,000 account minimum for a 40 basis point fee, you get one call a year to a CFP professional, an actual human financial advisor. If you're at $250,000 account minimums and a 50 basis point fee, so 0.5%, you get Betterment Premium, which gives you unlimited access to human CFP professionals. And then on top of that, there's another tier. Betterment is rolling out a Betterment Advisor Network, which matches consumers who want even more advice or maybe don't meet the other Betterment minimums to third-party CFP professionals who are using the Betterment for Advisors platform. So the basic takeaway is this: Betterment just raised fees on larger accounts over $100,000 and then rolled out 3 higher price tiers of human services for all of those larger accounts as well. And I think basically what that means is the pure robo-advisor model is pretty much officially dead now. And answering the question there, so these are all-in fees. So the Betterment Plus fee would be 15 bips on top of the 25, which brings you to 40 total. Premium would be 50 total, so call it 25 base plus 25 for the advisor. If you use the Betterment Advisor Network, it'll be the 25 basis point advisor platform fee plus whatever it is the advisor actually charges. So that'll effectively be stacked. Now, to be fair, as I wrote last year, the pure robo-advisor movement, frankly, was already dying. Betterment's growth rates have been falling for a while. Wealthfront's growth rates are crashing even worse. So no great surprise, a couple months after I wrote about that last year, a huge swath of their executives left. A couple months after that, their founder took back over the CEO role. And in the meantime, in the past year or two, we've seen this wave of robo-advisors capitulating. So Future Advisor got sold, GemStep got sold, Upside Advisor got sold, Financial Guard got sold, SigFig pivoted to institutions along with a number of others. Basically, the B2C robo-advisor movement was already on the way out. But I think the point that you see Betterment throw in the towel, we can officially stamp this as done. Now, it's also worth noting that a lot of things that have been called robo solutions serving consumers actually aren't pure robo solutions in the first place. The convergence we're seeing is that they're all becoming a combination of technology and human advisors. So what I first called the cyborg advisor, Joe Duran at United Capital later dubbed it the bionic advisor, which got a little more traction as a term. But this idea that there's still value to what humans do, but there's also value to what technology does. And the optimal solution is combining both. It's not the human or the robo, it's the tech augmented human. Because when you actually look, that's really what's already been dominating the landscape. Personal capital often gets dubbed a robo-advisor, but it's not. It's got human financial consultants working with clients, and although its asset base is smaller because it charges human advisor fees, it actually already had more revenue than all the other robo-advisors combined. Vanguard Personal Advisor Services is often called a robo. It's not. 400 plus CFP professionals serving clients directly across 3 large locations in the Carolinas, Pennsylvania, and down in Arizona. And even Schwab, which went to market with a robo-advisor, just announced that it's pivoting from Schwab Intelligent Portfolios to Schwab Intelligent Advisory. And the difference, Schwab Intelligent Advisory will offer 24/7 access to human CFP professionals. In other words, when you really dig into Landscape of Robo, what you find is that actually almost all of the B2C robo-advisors were already either gone, sold, dead, pivoted, or not actually robos in the first place, but human advisor solutions that were just using technology and might meet with clients virtually. And now what you're seeing is Betterment is doing the same thing, pivoting away from the pure robo tier, going into the tech-augmented human business, using its technology as the core platform, and then layering on higher price tiers on top of it, because 25 bips just doesn't scale the way I think that maybe they were hoping it would. And it's a big change when you talk about a new service that for higher ed clients boosts their baseline pricing by 40%, and the premium service would be triple the cost of what high-end clients were paying yesterday. Now, granted, you have to choose to pay up to that service, so it's not an automatic fee increase. But I think it says a lot when Betterment takes a core tier for 100,000 clients and says, here's a human advisor service for triple the pricing that they think they can sell. So for all those advisors who've been wondering all along, like how on earth in the long run am I going to compete with a robo-advisor like Betterment charging 50 basis points on large accounts while you charge so much more? Well, it turns out Betterment was trying to figure out how they can get the prices that we charge as human financial advisors. And now that's what they're rolling out, up to a 50 basis point service for Betterment Premium that gives you year-round, round-the-clock access to CFP professionals to augment the pure technology solution. So frankly, if that's not capitulation to the demand and higher price point of human advisors, I don't know what is. Now, in truth, I think it's worth noting that in terms of Betterment itself as a core business, I don't actually truly view them as pivoting to the human advisor business. I think actually what we're trying to see in terms of Betterment's model in particular is that they're trying to pivot to be a platform business. So the essence of a platform business is that you want to be a central clearinghouse that matches consumers with whatever things or services they want to buy. So eBay is a platform to match buyers and sellers. Amazon is a platform to match consumers and businesses. Google is a platform to match readers and advertisers. And I think Betterment wants to be a platform as well. And that's why you're actually seeing them offer a range of services. You know, I suspect Betterment just did the math and figured out, okay, offering once per year advice from CFP professionals costs about 15 bips. Year-round advice at scale will cost them 25 bips. So therefore, plus is 25 bips plus the 15. Premium is 25 bips plus the extra 25 bips. Any advisor that's on the Betterment Advisors platform also pays 25 basis points, and the advisor just charges their fee on top. So basically what you're coming down to is Betterment's business model is we want 25 basis points for our technology. That's it. You can be a self-directed consumer that uses it for 25 bips. You can get plus for 25 bips plus the limited CFP. You can be premium for 25 bips plus the full CFP, or you can be advisor network for 25 bips plus the advisor's fee. So Betterment just wants to be the 25 basis point platform for whatever it is that people want to buy, get their layer, and then cost plus up to whatever it actually costs to deliver the service. Now, I think that's notable because what it means in the context of us advisors is that I think Betterment's trying to shift from a model where they're in competition with us to a model where they're in competition with our custodians and direct-to-consumer investment platforms. So at this point, you're going to see Betterment offering these plus and premium services with human advisors, but I don't think they're actually trying to stake a position against advisors. I think they're trying to stake a position against companies like Schwab, Fidelity, and TD Ameritrade, because all of those are direct-to-consumer brands that make their money as platforms. So for any of those major players, you can get self-directed trading, you can get managed accounts, you can get human advisors, who in many cases are CFPs. They've all got advisor networks if you want even more and deeper advice. And that's the gist of their model. They don't care per se which one you choose. They just want you to choose anyone on their platform, right? So if you look at Schwab as kind of the quintessential example, we've got self-directed trading, managed accounts in a robo solution, Schwab Financial Consultants, Schwab Private Client, Schwab Advisor Network. And now Betterment will have Robo Managed Solution, Betterment Plus, Betterment Premium, Betterment Advisor Network. They're just lining themselves up in the same way. Now, it's notable that actually a lot of custodians have a really, frankly, challenged business model right now. They make a couple of basis points of revenue on their asset base. That's it. Some custodians on all those $9.95 trading fees, when you add them up, their revenue relative to AUM is like 3 to 5 basis points. That's actually why you saw the launch of solutions like Schwab Intelligent Portfolios, Fidelity Go, and TD Ameritrade Essential Portfolios, because from their perspective, if you can get just 25 to 30 basis points in a robo managed account, that's like a 10x multiplier in your revenue per assets compared to traditional custodian or brokerage services. So frankly, if Betterment can pull this pivot off successfully, they could start a trend of custodians trying to raise fees, because frankly, almost everything else, the custodian model is getting commoditized down to nothing, especially with DOL fiduciary coming through, and what I think is going to be a new wave of pressure on 12B1 fees, sub-TA fees, getting the ultra-low share class that has all that stuff stripped out. The custodial model is under assault, and their dream is to be able to get 25 basis points like what Betterment is going to be charging. Now, from the flip side, I think the question is still whether Betterment's going to be able to compete in the space or how they're going to compete. So, Betterment Premium launched a service for 50 basis points with a $250,000 minimum to get year-round access to the group of CFP professionals. But Vanguard does the same thing for 30 basis points with a $50,000 minimum. Schwab Intelligent Advisory does it at 28 basis points with a $25,000 minimum. So in other words, if even in a world of giving access to CFPs plus digital services, Betterment's coming in at a price point that's 80 to 100% higher than Schwab and Vanguard, and they're coming in at a point with 5 to 10 times the minimum of Schwab and Vanguard. So, frankly, this doesn't look so much like Robo Disruption. Now it's actually the Robos that are getting disrupted by the incumbents, a trend that I had talked about in early 2015, that eventually major players were going to come in like Schwab and Fidelity and offer robo services for nominally free in exchange for just trying to get the assets. And so now Betterment has to actually face a challenged higher price point to compete against the incumbents. So, beware trying to go against companies that have a couple $1 trillion of scale as a head start. Which means ultimately, I think actually Betterment is still going to live or die by the same thing that's been threatening it from day one, which is client acquisition costs. The question of whether Betterment will be able to get clients offering a fairly similar service to Schwab and Fidelity at almost double the price and quintuple the minimums. In the near term, I suspect Betterment will actually get a revenue bump, because frankly, they already have some clients above these thresholds who might be quite interested in paying for advice, and that's like an instant upsell for them. In the same way that when Schwab launched Intelligent Portfolios, it immediately got a nice revenue bump when it converted existing brokerage clients who, again, only generate a couple basis points of revenue per AUM into robo clients that bought Schwab ETFs in the robo wrapper for like a 10x revenue multiplier. But in the long run, Betterment still has to figure out how to market this service with higher minimums and higher price point against larger competitors with larger marketing budgets. Now, that's not necessarily impossible. Betterment, to their credit, pivoted earlier than almost any of the other robos to recognize they had to build a direct-to-consumer brand to possibly be successful. And that, I think, is why they've already pulled ahead as the largest robo-advisor in the space. And frankly, Personal Capital is still managing to do this at 3 times the price point of Schwab and Vanguard, because their fee schedule starts at 89 basis points. Now, the unique thing about Personal Capital being this hybrid tech-augmented human advisor is that they have a really unique client acquisition system, a personal financial management app that consumers download for free and use and basically self-identify themselves as prospects that Personal Capital can call. Now, Betterment doesn't necessarily have that kind of marketing channel, but frankly, Personal Capital hasn't even fully staffed with CFPs. Betterment at least is making a commitment to staff with CFPs, although you still have to get up to some of the services like the high end of Schwab and Vanguard to actually get dedicated CFPs working with you. Otherwise, you've got to go to the Betterment Advisor Network. So the opportunity is if Betterment can figure out this marketing challenge, it's a really nice opportunity for both their retail service, their plus and premium tiers, and Betterment for Advisors. And probably in particular, I'll even highlight the Betterment for Advisors, because certainly as I think most of you are feeling as well, it's getting harder as a financial advisor to differentiate and do marketing right now. And Schwab, Fidelity, and TD Ameritrade have long since validated that advisors will go where the opportunities are to get client referrals. And all of those platforms have successful, thriving advisor network programs. So if Betterment can make it rain with new clients, even if they just route all of it to the Betterment Advisor Network, that's still a win for Betterment, a win for advisors, and I'll argue a win for consumers because they're being served by a CFP professional and some good technology. So it remains to be seen whether Betterment can successfully execute that marketing, and frankly, whether the external advisors will even get picked when they get put right next to Betterment Premium at 50 bips and Betterment Plus at 40 basis points. Will the consumer still choose the direct one-to-one advisor at a higher price point? I'm a little more than a little curious, frankly, to see that, since our own XY Planning Network is a major user of Betterment for Advisors and has the potential to get some clients. So I'm certainly hoping that channel works out on behalf of our advisors. But the bottom line is just to recognize that I think this is a really profound shift from Betterment, and one that I think really marks the ultimate demise of the pure B2C robo-advisor. Wealthfront is basically the only pure player left standing at this point, and frankly, the one that's still got the most mediocre growth rates, which doesn't bode well for them. Instead, I think what we're seeing is the whole what's old is new. Betterment is now trying to reinvent itself as a modern investment platform, I think akin to Schwab, Fidelity, and TD Ameritrade, serving consumers and advisors and trying to do with what they hope will be perceived as superior technology. Because as I've said all along, the robo technology is a real phenomenon and is here to stay. I mean, who doesn't want better automation of trading and rebalancing, tax loss harvesting, and digital onboarding? That's always been a demand. And I think the true, to Betterment's credit, nobody in our industry realized how bad our technology was until Betterment and the following companies showed up and kind of revealed to everyone just how bad our technology was. But still, now Betterment's going to have to do what every platform brand ultimately has to do, go out and market it and see if they can get enough distribution to hit critical mass. We'll see. So I hope that's helpful. Some food for thought on the big news today on Betterment offering human advisor services. This is Office Hours with Michael Kitces, 1 p.m. East Coast time on Tuesdays. Thanks for hanging out with us and have a great day, everyone.